Hello everyone and welcome to this week's webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you very much for joining us again. We did of course have a webinar last week, so hopefully we'll be able to provide you a little update on what's been happening since. I assume everyone can hear me, but if you can, then please let me know. Perfect, thank you very much. Yeah, so the format is as usual. We'll take a look at some of the key macroeconomic events that we have coming up this week. And then we'll take a look at the charts. For me, I think there's two things that really do stand out. One of which may seem more relevant to those of you who are looking at these FX pairs, and for others it may not seem as relevant. The one that I think is going to be most relevant, particularly if you're trading the Canadian dollar, will be the Bank of Canada on Wednesday. The Bank of Canada is expected to raise interest rates, according to Thomson Reuters earlier on today. The rate hike is more than 90% priced in, so I think we can expect plenty of volatility around that announcement. Clearly, traders very convinced that we are going to see that rate hike. We had two rate hikes from the Bank of Canada towards the back end of last year in succession. We had a break after that, but it seems like some of the recent data which we've had has convinced them that more rate hikes are necessary already. I think the most notable one was the unemployment, the jobs report, which we had a couple of weeks ago for Canada, which showed unemployment, I think, fell by 0.3%, and wages look good as well. So I think these things, combined with some of the latest inflation data, potentially giving the Bank of Canada reason to believe that higher rates are needed. It's going to be interesting to see how the economy responds to this. We know that there's high consumer debt levels, for example, which could impact the economy due to the higher rates. But I think that's more of a longer term thing. In the near term, like I say, this is priced in. If we don't see a rate hike, you'd expect to see negative implications for the Canadian dollar, given how heavily it has been priced in. As I say, I think that's the key economic event this week. That's a high volatility event, as you can see on the economic calendar here. There's plenty more economic data to come, though, which we'll touch on in a second. The other event this week to pay attention to is just earnings season. Earnings season started in the US on Friday, with some results from some of the banks. It's going to continue this week. It's going to ramp up over the next couple of weeks. You may not be an equities trader. You may not even be an indices trader, but keeping an eye on how earnings season is going, I always think is important. I think it's a key driver of sentiment, which affects all markets. If earnings season takes a turn for the worse and completely undershoots expectations, and expectations are high going into this earnings season, then that can typically weigh on sentiment, and therefore you start to see safe haven plays starting to be preferred. Of course, if you're a pure technical analyst, you're not really looking for the reasons as to why markets are moving as they are, but I think it's always nice to be aware of these things. So that's something I would be personally keeping an eye on. But like I say, there's a lot of economic data to come this week. We had, for example, the CPI data from the UK this morning. That's weighed on the pound just a little bit, particularly against the dollar. I think the pound is slightly outperforming the euro, but in general, I think the pound saw a little bit of weakness on this. Like I say, particularly against the dollar, which we'll see in a little bit. The dollar's pairing its losses from the last few days. We've seen heavy losses in the dollar over the course of the last 3 trading sessions. It's pairing those losses today, and I think the pound against the dollar is seeing slightly higher losses due to this inflation data. And the reason why, even though you can see green here, you think that should be positive. Well, the CPI data year on year came in line with expectations. It fell from 3.1% to 3%, but the core number fell a little bit more to 2.5%. And why that is negative for the currency is simply that people are starting to price in more rate hikes from the Bank of England. We saw one last year, bringing interest rates back up to 0.5%, undoing effectively the emergency rate cut from the after the Brexit referendum result. And there's been speculation that we could get more. Now, I'm a believer currently that we won't see another rate hike this year. I don't think it's necessary. I think the economy is fragile, underperforming the other nations, despite the fact that the global macroeconomic environment is positive. And with inflation not at dangerous levels, I don't see it necessary to raise interest rates again. And the fact that this core inflation number is coming down Should it stay around these levels or continue to drop, that will remove the pressure on the Bank of England to raise interest rates again. And the fact that the core number fell a little bit in people's minds has clearly had a little bit of an impact. And that if the Bank of England is going to raise rates more slowly or later than the markets were expecting, then that will typically be negative for the currency. So that would explain that move this morning that we've seen in the pound over the course of the next few days. Like I say, more data to come. CPI data from the Euro area. It was a slow start to the week, but then the bank holiday in the US never helps that. We've got some mid-tier economic data, of course, from the US here. We've got plenty of central bank speeches, as always. We've got Saunders here. We've got Kaplan and Mester from the Federal Reserve. Beige book I don't tend to pay too much attention to, if I'm perfectly honest. Heading into Thursday, more data again, a lot overnight. So that's something to be aware of at the start of the session. We've got some Australian data for you Aussie traders, employment data here. Got retail sales, industrial production, and the GDP from China. So that could have an impact on sentiment heading into the start of the European session. And then again, we've got some mid-tier US economic data in the afternoon. And we'll wrap things up on Friday with UK retail sales. So these are two important reports for the UK. I don't think we can underestimate this. A key driver of the slowdown in the UK over the course of the last 18 months has been the consumer. The consumer is an extremely important part of the UK economy. And this high inflation and low wage growth that we've seen on the back of the Brexit, and wage growth wasn't particularly good before that either, has squeezed disposable incomes and therefore squeezed spending. And that has partially led to a slowing of the economy. So inflation has eased off a little bit. If we can see retail sales picking up, then that'll be seen as a positive sign for the economy. We are expecting to have seen a positive December. I tend to look more at the smooth curve over a few months rather than the month-by-month movements. But this is, of course, would be a positive development here. We can scroll down here and see the gradual trend of core retail sales, for example, over the course of from late 2016 onwards. Quite clearly a Brexit effect there, which explains the slowing in the economy, but that has also coincided with higher inflation, so it's not something we should be particularly surprised about. So I think that's the key events from an economic standpoint this week. There's been more reports, of course, early in the week about Germany, and this is really one of the risks that it's just dissipating, I guess, is that Germany, Angela Merkel, appears to come to an agreement with the SPD to form a coalition in the early stages still, of course, but that's a positive sign there. Germany continuing to lead the way in the euro area, and political stability there is going to be essential. Geopolitical risk continues to be an underlying risk for the markets. We're not seeing anything too worrying sparking at the minute, and I think that's one of the reasons why we have seen this more general positive mood in the markets. So I think that's what that'll do from a fundamental standpoint. We'll move on to the charts now, which I imagine is why most of you have logged on here. And we'll start with euro dollar. So, as I say, it's been a very, very tough few days for the US dollar, and that's quite clear when you just look at this chart here. We had this move higher. We looked as though we were kind of sideways trading here throughout December. And then we finally broke through those highs and made new highs here. At the start of January, we had a bit of a pullback. We've pulled back in towards the 50 fib zone around the 119s, and then we have rebounded higher, so we can remove that fib. We went through the previous highs because that's where we held up initially. Prior resistance turned current resistance, and now we've blown through those levels over the last few days, and we've kind of come stuck a little bit again around previous highs. Now, if I just zoom out quite a while, because I think these are highs from 3 years ago, if I'm not mistaken. Yep, so these are levels we're literally talking about December of 2014, so just over 3 years ago. We've run into a little bit of resistance there. The difference between this and well, not the difference. We've run into resistance around this level. At the moment, that looks more like consolidation, so I'm not particularly bearish. If we do see a pullback, then the most notable level to look out for initially will be those 121s, with it being prior resistance. If it pulls back again, you could also keep an eye on key fib levels once again. So again, the 50 and 61.8 comes around that previous resistance, and a break through those levels, then I would be looking more towards like the broader correction area, so around the 119.25s. getting a bit ahead of ourselves though, because all we're seeing at the moment is a little bit of consolidation in what is a very bullish move in euro dollar, or rightfully a very bearish move in the US dollar. In cable, we've seen a similar move. Again, this is very dollar driven, so don't be surprised if a lot of what I say over the next 10-15 minutes is quite similar, because a lot of this is dollar related moves. There's a reason why commodity markets have performed well, and that's because they're priced in US dollars, and therefore when you see a weaker dollar you tend to see stronger commodities, and there's a reason why a number of these other currencies have therefore performed well against the US dollar. In terms of why the US dollar is falling apart all of a sudden, it's difficult to give one particular reason, if I'm perfectly honest. You can point to the fact the flattening yield curve has been used as an example of why we're seeing a weaker dollar, and people concerned about whether the Fed will be able to raise interest rates as fast as it wants to, because it doesn't want a flattening of the yield curve, because that tends to signal a recession, and it's not a desirable picture for the central bank. So they would typically slow their rate hikes if that was happening, and I think that's something the market seems to be speculating about. Another reason is simply that the dollar is suffering as a result of other central banks. So the fact that the Bank of Canada becomes more hawkish, the fact that the ECB has become more hawkish, and the economy there is performing much better, and people are starting to factor in a faster pace of tightening than the ECB has previously suggested. We saw a strong move in the euro on the back of the ECB minutes last week, and that came as a result of the ECB indicating that they're going to have to give plenty of time for the markets to factor in tightening, and effectively pointed to early this year when they'll be giving hints about what's going to come post-September when the current QE program expires. I don't expect another taper. I expect it to end in September. This boosted the euro as well. There was the Bank of Japan last week, which in its purchases of Japanese bonds earlier this month, purchased 190 billion yen of 10 to 25 year bonds rather than the normal 200, and they purchased 90 billion yen of 25 to 40 year bonds rather than the usual 100. So this was seen as a sign of the market for the markets that the Bank of Japan is looking to be less accommodative. So all these central banks making these hawkish sounds is negative for the dollar, because you're looking at the Fed potentially slowing its tightening and others picking up the pace. And I think this has really hurt the dollar as well. I think there is other factors at play as well, but I think these are two of the most clear ones. So that's seen us go through this previous resistance zone. So now you're looking back, and we're actually at post-Brexit highs now. So we're back at the kind of levels that we blew through on Brexit Day, back at these kind of high 130s. The next notable area of resistance comes around that kind of 138.35 area. That was the pre-Brexit low back here. I think this one's a more notable one around 140, with it having been supported on a number of occasions pre-Brexit, and with it being that big round number, the big psychological level that we always talk about. But at the moment, it's doing well. We're seeing some consolidation, as in the euro. I wouldn't write off the possibility that we see a bit of a correction before we see another move higher. Equally, given the strength of the rally that we saw here, I wouldn't be surprised if we see a little bit of consolidation and a push higher. But look, I guess what I'm saying right now is I continue to be bullish. I'm not seeing any reason to believe that we're going to see a rotation, a significant rotation lower. The momentum indicators are certainly looking bullish as well, supporting the trend. Euro sterling, I've not really got anything to update on top of this. We're just seeing a lot of consolidation, a lot of choppiness, with the euros looking quite strong right now, the pound's looking quite strong right now, and I think that's resulting in choppiness in this cross. I've not really got much to add to it. I think you've got a notable zone around the 88.40, 88.60s as support and resistance, but as you can see, we're just chopping our way through that. We had support here, chopped below. We had resistance here. We then had a number of resistance here. We went above, found support in this zone, went below, found resistance, then went above, and now we're finding support. Not particularly interesting, and not one I'm going to spend long on for that very reason. So Sean is asking, would it be the same for all US dollar pairs? It is a very common theme. I think every pair is different, and it's worth considering that, Sean. There's always two factors at play. For example, so if you're talking about, for example, the yen, which is not doing quite as well generally against the dollar as, say, the euro, then there's two factors at play as to what's driving that: the European Central Bank versus the Japanese Central Bank. But even the yen is doing quite well against the US when it comes to the US dollar, as we'll see when we get to those charts. It all depends on what currency that you're looking at. It seems that in a lot of the ones that we're looking at now, for example, the theme is very consistent. Aussie dollar, for example, we were keeping an eye on these 50.61.8. We seem to be respecting these levels with resistance here, support here, and we've just kind of blown through that in the last few days. So if you ever need evidence that this is not a trend continuation move down, then that was very much it. This continues to look bullish. I said in the last video, if we blow through that 50.61.8 kind of level, then that would suggest to me that this is looking much more bullish in the near term. We're still in this kind of support and resistance zone here. So you can see that we had support in this area here and resistance here. So I won't be surprised if we see some consolidation, even a minor correction. We're coming up towards those kind of 80, which is a psychologically important level. But ultimately, I'm looking back towards these previous highs around 80, 50 to 81. And I think these are very potentially very achievable levels. We're looking at the momentum indicators underneath. And at the moment, we've got a lower on the MACD histogram. The lines are continuing to point higher. There's no divergence on the stochastic at this moment in time. Don't be surprised if that starts to form around the 80, 50s to 81, because then we are trading back at long-time highs. Dollar CAD, again, is going to be extremely interesting. The weaker dollar coming against the strong Canadian dollar ahead of this potential rate hike that's being priced in. As I said in last week's webinar, please do ignore that spike. That's a false spike. It didn't show on the live account, so it won't have impacted any live trading that you are doing. It has shown up on here. We are looking to get it removed, so just ignore that in the near term. We continue to find a support around here, but it'll be interesting to see if we do get that rate hike tomorrow, given how priced in it is, whether that triggers a move below here and below this previous low here from earlier on this year. A breakthrough here, then you're looking back towards these kind of support zones, which, again, I think there's strong potential for this to happen, just because the dollar is looking so weak right now and expectations for the Bank of Canada are ramping up quite considerably. Moving on to sterling CAD, and this, like I say, the pound has been performing quite well, and you can see that here. So even though we're expecting a Bank of Canada rate hike, the pound is just clearly outperforming it right now. Now, I think there's a couple of things to consider here. One is the fact that we did see the break of this rising trend line, so the momentum, the longer term momentum, really looks to be building to the downside, although we are still in the upward trend. I'm very intrigued by these kind of resistance levels around the 1561.8, where we are currently running into resistance, prior area of resistance as well, and further back also. Should we see a rotation lower off there, then that would be quite a bearish signal, and it wouldn't surprise me if we're looking back at these kind of 168s in the near to medium term. I've also got the 78.6 on here, which I don't know, which is a fib level I don't ordinarily use, but because we were in an uptrend and we had that initial break, which is an early warning signal effectively, sometimes you can see deeper retracements. So I did want to highlight the 78.6. Apologies for the delays in what I'm saying. There's a fire alarm going off behind me, so I'm just making sure I don't have to run out the building. Luckily, it seems that that's been resolved, so I can continue with the webinar. Otherwise, I would have had to end this prematurely. But we can continue. So the 78.6 is a potential zone. I'm very intrigued by these 1561.8. We've clearly seen resistance here. I'm looking for signals of a rotation lower. We could look at the 4-hour chart for potential signs of that, because you can see we've run into resistance twice around these levels. Should we see a breakthrough those 70.75s, that could be a bearish signal for a continuation of the move lower. a break through that 71.75 kind of level, and it may end through that 72, and it may suggest that we are looking at a deeper retracement. But at the moment, I'm looking at this right now, and I'd say there's a bearish consensus building, but like I say, in the early stages of a trend reversal, that can sometimes create deeper retracements than you would otherwise see. Kiwi dollar next, and as with the Aussie dollar, which I actually forgot to mention, there's two things that I think is really the same thing is really helping the Aussie dollar and the New Zealand dollar when compared to the greenback. One is that the US dollar's weak, that goes without saying, but as I said earlier, when the dollar's weak, it tends to help commodities because the commodities are priced in dollars, making it cheaper for non-dollar buyers. So when you've got the weaker dollar helping commodities, it tends to help commodity currencies that little bit more, because if commodities are rising, that tends to boost your commodity currencies. So you've almost got an additional boost for things like the Kiwi dollar and the Aussie dollar. So while there hasn't been any particularly strong fundamental news with regards to the Kiwi dollar or the Aussie dollar, we're still seeing this very strong rally, and I think the rally in the commodity area is helping to drive this. Now we've gone through the 61.8 fib. I'm not really interested in that level anymore, just as with the Aussie dollar. This is a clearly strong trend building based on weaker dollar. This doesn't look like a correction or a retracement to me. I'm keeping a very close eye on these kind of 73.50s through 74s where we've run into resistance before. It wouldn't surprise me if we build on beyond this, but you can see that quite clearly 73.50 through 74 has long time been a notable area of resistance. Should we break through there, then I'll be looking back towards the 75.50s, but near-term resistance is coming here. I'll be keeping a very close eye on the momentum indicators to see any divergences building, not for a rotation lower per se, but a potential correction given that we've come off a very strong rally over the course of the last month or so. Dollar yen, we've continued in much the same vein that we have for the last year almost. We're in between that 108 to 114.50. Times we looked as though we could break above, but this weaker dollar really has smashed it. So we held up in the Ichimoku cloud for some time. We have found support just about here. We came back up and looked as though we were going to face the upside, but we've made another lower high here and here, and then we've just smashed through those levels now. We've gone through the previous support, but also importantly, we've seen that the lagging line has also followed us through the Ichimoku cloud. Now, it's worth noting that in choppy sideways markets as we've had over the last year, the Ichimoku cloud tends to come with less importance in much the same way that moving averages do. But I still do treat it with maybe some significance, because every time we've gone through the cloud, we have gone to these extreme highs and lows, or most of the time anyway. So the fact that we've gone through the cloud here and the lagging lines followed, if we do see a retracement, then I would have kept a close eye on that 111 from above, with it being prior support. But also with it being the top of the Ichimoku cloud, it seems that we've already run into support here in that area today. So I wouldn't be surprised if this does continue lower. If we do see a deeper retracement, then 111.75, 112 I think will be notable. 112 with it being prior support here. 111.75 because of the combination of the 200 and 233-day simple moving averages, as well as this prior support zone here. Fib levels are also useful in this scenario as well. So that opens up the 112s once again for the 50 fib. Ultimately, I think as with other pairs, I'm still bearish on this pair in the near term. I think 108 is very achievable at this moment in time, given the way things are going. Momentum is with the bears, so there's no reason for me to question this. Everything seems to be pointing down currently for dollar yen. Of course, that's just my opinion, I should state. As you saw from the disclaimer at the start, none of this is a trading advice, just to be clear. Sterling yen is trading back at the top of the range, and that's what I was saying about the yen earlier. The yen's performed quite well at times, especially on the back of those Bank of Japan reports. But you look at the way the dollar's comparing to the yen versus the pound and the euro, and that they look like two very different stories. We're trading back at the top end of the range. So far, we've struggled to break through here, despite numerous attempts through that 153s, 153.50s. See the long upper wicks forming here was a sign that we were going to struggle. We had the evening star formation, which came here and brought us back, but then the 50 and 55, the 55 and 89 day simple moving average combining here with the top of the Ichimoku clad, and we've seen this strong rotation higher. So we've effectively seen an evening star formation followed by a very strong morning star formation. I think there's potential for this to break. This rotation off the Ichimoku clad, the moving averages, and that very strong reversal formation. I think there's going to be a lot of upside pressure and a breakthrough that 153.60 high, whatever it is. And I think we could be looking much higher from there. And again, we're having to go right back to pre-Brexit to look at levels that we were trading at here previously. So if I'm looking here, I'm looking at this kind of low area here for next possible resistance around that kind of 155.50s, 156s. This was low here. It was a peak. It was an area of resistance here, support here, and kind of resistance here. So this is the type of area I'd be looking at for next possible resistance. But I think a breakthrough, this now long-term resistance, opens up a potentially significant move higher. And again, 160s potentially in the medium to long term could be a possible area that we're looking at, although that seems quite a significant push from now. This could take some time. There's always a lot of fundamental factors at play when it comes to the pound, but don't underestimate how bullish a breakthrough these previous highs would possibly be. Finally, euro yen, and again, same with the pound. We broke through these previous highs here, and then we rotated back. We found support from the 55 and 89 day simple moving average, and also the top of the Ichimoku clad. We've seen a nice bullish reversal higher. We've yet to challenge those previous highs, but we've already broken through this longer term high. I still think this is bullish. I think if we can get a breakthrough these kind of 137s, then we could be looking very nice indeed here, unlike, of course, the dollar yen. And I think then if you're looking for potential levels, the kind of 139s, 140s, I think is going to be the next big test for this pair, as we saw back here back in 2015, which is such a long time ago at this stage, but you can see even previously back in 2014 as well, this was a notable area. So that would be one to keep a close eye on. Momentum doesn't seem to be lacking too much. We haven't made new highs, so you can't pay too much attention to this part yet. If we've made new highs and momentum was falling off, then that would potentially be a bit of a bearish signal, but we've yet to make new highs. It doesn't look as bullish as sterling yen, if I'm perfectly honest, but then I really think there's potential upside moves here. We need confirmation, but I think the euro is looking quite nice at this moment in time, and I think should we break through those highs, then that could be the catalyst for another push higher. That's all we've got today. I hope you found that useful, and I hope you join us again. I think we either have another webinar next week or the week after. I should check this before I come on, really. But again, thank you very much for joining us. I hope you found that interesting. And apart from that, I wish you all the best with your trading this week, and I'll catch you again very soon. Thank you very much.